Good morning, everyone. My name is Mr. Dipahwe. I teach in a school by the name of Sinagangwedi Secondary in Botshabelo, outside Bloemfontein in Motheo district. I will be taking you through your June examination 2015, questions 4, 5, and 6. Shall we start right away? Question 4, it's about audit report and balance sheet for 60 marks, 38 minutes. 4.1, read the following statements and identify the type of opinion that will be given by the external auditor. Use the words in the block to guide you. Words in the block, the first one is disclaimer, the second one unqualified report, the third one is qualified report. For you to be able to get 3 marks, you need to understand at least 2 of those words in the box. Let us start with the easy ones, because I believe if you may not know what a disclaimer is, but surely qualified and unqualified, you should be knowing something. Just to get everything clear, unqualified report is a good report. Qualified report, it's not so good report. A disclaimer, it's when the auditors cannot give an opinion on financial statements because of whatever the wrongs that they found in the financial statements. Right away, 4.1.1, the statement reads, the auditor is generally satisfied but highlighted a few concerns. I believe you will all agree with me that the answer to that should be a qualified report. Moving on quickly to 4.1.2, the external auditor is not prepared to issue an opinion. Is not prepared to issue an opinion on the financial statement. Surely that would not be an unqualified report. That should be disclaimer. Moving to 4.1.3, the financial statements fairly present the financial position of the company. That will go to the third one, the remaining word, which is unqualified report. I believe that was very simple. Moving on to 4.2, quickly before we go to 4.2, can you just confirm the answers to say 4.1.1, qualified report like we said, 4.1.2, disclaimer, 4.1.3, unqualified report. We are moving to 4.2. Explain why a business would need an internal auditor in addition to an external auditor. Why an internal auditor if at the end you are going to need an external auditor? I believe here we need to understand that the internal auditor is the one who is employed at the business, employed by the management of the business to see to it that the internal control measures are taken into account or are in place. I believe that was fairly an easy question. Now moving to 4.3, Richie Traders Ltd. The following information was taken from the accounting records of Richie Traders Limited. The company has an authorized share capital of 2 million shares required. There are 2 questions on 4.3. Prepare the note for fixed asset on 28 Feb 2013 for 20 marks, which is the question that we shall be dealing with right away. I want learners to remember that if the question says prepare the note for fixed asset, you should be knowing we are dealing with fixed assets, nothing but fixed assets. Now let us look at the information that we have. Unfortunately, I do not have my answer book with me, but I believe this question paper will assist me. When we look at the given incomplete fixed asset note, starting with land and buildings, we will take them column by column so that we get to understand exactly what is happening. In column 1, land and buildings, opening balances, we are given the cost there and the cost over there. And when you compare the two costs, you find that this one is bigger than that one. There is nothing there for disposals and depreciation. There's only one question mark. That means something was bought during the year, hence the additions there. Let us look at the information that we have from the same question paper about fixed assets, in particular land and buildings. It says a new store was built during the financial year. That confirms the question mark that we see over there. I want to believe that if you started with a cost of 1,100,000 and at the end you have a cost of 1,500,000, there is an addition. And the addition will be the difference between what you have at the end and what you have at the beginning. And it's easy with the calculator. 1,500,000 minus 1,100,000, the answer is 400,000. It's one mark because it wasn't that difficult. Moving to the second column. When you look at the second column, there are about 5 question marks. Cost is not given. Accumulated depreciation is not given together with the carrying value at the beginning of the year. Movement, what happens during the year. Nothing was sold. Something was bought. But now we need to calculate the carrying value at the end of the year. Of course, there is no accumulated depreciation. Now let us check the information that we have. Like I said, we are going to take it column by column. Now, when we look at the vehicle, we need to go down a bit to check information on vehicles. Those that we are done with will tick them to show that we are done with them and there's no need to go back to them. Vehicles, the information reads thus: with the exception of vehicle bought for 240 there on 31 October 2014, the business bought the other vehicle on the 1st of March 2011. At the beginning of our question, just to remind you quickly, the beginning of our question, we were asked to prepare the note for the fixed asset on 28 Feb 2015, which is the last day of the year, 28 Feb 2015. But the information that we are given says, except the vehicle that was bought during the year, which has already been recorded, the business had already bought the other vehicle long time ago, that is on the 1st of March 2011. Don't forget we are in 2015. The current year goes between 1 March 2014 to 28 February 2015. Bear in mind, no vehicles were sold during the year. What does that mean to us? We do not know the depreciation on the vehicle which was bought on the 1st of March 2011. It means we have to calculate it. Point number 2, so that we can be able to get the carrying value and move on to depreciation for the current year and this one. Now, we have to calculate that given the information that we have. Let us quickly look at the information given to us. let us look at the vehicles. The information that appeared there on the question paper is for the last day of the year, 28 February 2015. But when we check on our answer book, that 740 should be equal to the amount given on the question paper that I've just shown you. I believe that was a mistake, but it does not change what we are busy doing now. The cost at the beginning is not given, but the cost at the end is given. Something was bought during the year. Given this figure, we are able to work backwards to calculate the cost at the beginning of the year. How do we do that? We take the 740 minus what we bought during the year to calculate what we started the year with. That will be the opening balance. I believe with my calculator, 740 minus 240 will give us 500,000. I'm sure you are helping me with the calculation. 740 at the end minus what we bought during the year will give us what we had at the beginning of the year, which is 500,000. Because if we take the 500,000 plus this, it will give us what we have at the end of the year. But now the biggest problem is calculation of the depreciation. If you remember well, the information given said to us, this vehicle was bought on the 1st of March 2011. Therefore, we have to calculate depreciation from the 1st of March 2011 to date. By to date, I mean until 28th of February 2015. I think it's important that we do it all together quickly. 1st of March 2011. Remember, financial year ends 28 Feb every year. If it started on the 1st of March 2011, it will end 2012. That was the first year. The second year, 1 March 2012 to 28 February 2013. That is the second year. Third year, 1 March 2013 to 28 February 2014. Now this is the current year, which started on the 1st of March 2014 to which will end on the 28th of February 2015. Remember, we want to calculate the opening balance for accumulated depreciation. Now, this is how we're going to do it. We can quickly look at the information given. They say depreciation on vehicles is written off at 10% per annum on the diminishing balance method. This rate has been maintained over the years since the business came into operation. In other words, in our first year, we started with the cost that we have just calculated, which is 500,000. Remember where the 500,000 came from? We took 740,000, which is the closing balance for as a cost. We subtracted the cost for something that we bought during the year. That's how we got the 500,000, which is the vehicle that was bought on the 1st of March 2011. First year, no problem. We multiply that by 10%, and I want to believe the answer should be 50,000. For first year, let me write it down there. First year, it was 500,000. We multiply that by 10%, and the answer should be Yes, 50,000. Second year will be a bit different because we are using diminishing balance method. We take our cost minus accumulated depreciation. After the first year we got 450,000, which is our carrying value, and then we multiply that by 10%, and the answer, I believe, should be 45,000. In the third year, remember this has been in the business, this is the fourth year now, but the amount for the first 3 years is not given, therefore we have to calculate it. Now on the third year we take the cost minus total accumulated depreciation for 2 years, which is 95,000. We put it there. I believe the answer should be 405,000, which will be multiplied by 10, and the answer should be 40,500. Now at this stage we are able to say the opening balance, the balance on the 1st of March 2014 is the total that we got from first year, second year and third year. That would be 95,000 for first and second year, that is the total, plus the 40,500 for the third year. With my calculator, 95,000 plus 40,500 will give me 135,500. This is the amount that will be the amount that we are going to start the year with as an accumulated depreciation, meaning we are going to put it there, 135,000. Remember the cost that we calculated was 500,000. Now we can easily say 500,000 minus 135,000, and the carrying value at the beginning of the year would be 365,000. Now that we are able to, or we were able to calculate that, we still have to calculate depreciation for the current year. And once we have that depreciation for the current year, we'll be able to get the carrying value at the end. Let us quickly calculate the depreciation for the current year. Remember, we are using diminishing balance method. Still on the same paper. Remember, the cost is 500,000. I'm still using the information on the old vehicle. 500,000, which is the cost, minus total accumulated depreciation for 3 years, 135,500. This amount will give me 500,000 minus 135,500. The answer is 364,500. That is the amount to be multiplied by 10%. The answer should be 36,450. Now, this 36,450 is the depreciation on the old vehicle. If I need to remind you quickly, we bought another vehicle during the year for 240,000. It came during the year. We still have to calculate depreciation on the same vehicle. That vehicle came to our business on the 31st of October 2014. It means we need to calculate depreciation from the first of the month that comes after October. We cannot include October because it's done already. It's the last day of October. and then the month that would come after October would be November. So that new vehicle has been in the business for November, December, January, and February. That means it's 4 months. 4 months at 10%. Remember, the cost for the new vehicle is 240,000. Now, with my calculator, 240,000 multiplied by 10, divide by 100, multiply by 4, divide by 12. Oh, I made a mistake. Sorry about that. 4 divided by 12, multiply by 10, divide by 100, multiply by 240,000. The answer that I got is 8,000. Now, this calculation, remember, it's on the new vehicle. Now we need to add this 8,000 to the 36,450 for the old vehicle. That will give us the new total for depreciation, which is 44,450, which we will put there. I'm sorry, I do not have my answer book. 44,450. It's supposed to be there. Now that we have depreciation, this figure for the year for both old and new vehicle, we take that and add it to the opening balance that was calculated, 135,000 plus 44,450. That will give us the total depreciation at the end there, 179,450. Now it's easy to get the carrying value at the end. We just say cost at the end 740,000 minus 179,450. The answer that we get there, I don't have space there, but I'll put it there, 560,550. 560,550. We are done with a calculation of the vehicles. All the calculations, we are done with them. Can we just confirm that on the memo? I believe you still remember how we got that 135,500 is 2 marks. The cost that was calculated by taking 740 minus this, it's correct, 1 mark for that. 500,000 cost at the beginning minus accumulated depreciation gave us the 364,500, which is the carrying value at the beginning of the year. Now we took that amount, accumulated depreciation beginning, plus the depreciation. It gave us 179,950. I believe everybody is still following correctly. We shall be moving on to equipment. With equipment, we are given the cost at the beginning, accumulated depreciation at the beginning, which makes it easy to get this figure there. This figure. 390,000 minus 156,000 will give us 234,000. 234,000. It was easy to calculate. That should be 1 mark. Going to additions, there is a question mark for disposals, question mark for depreciation, question mark for carrying value, question mark for accumulated depreciation at the end of the year. It clearly says we need to calculate them. Let's go to the information and see what they say about the equipment. The information on equipment It's on page 16 of your question paper. Page 16 of your question paper. Old equipment bought on the 1st of March 2011. Remember, we are in 2015. Old equipment bought on the 1st of March 2011 for 60,000 was sold for cash. On 31 August 2014 for 34,000. New equipment was bought for 120,000 on 1 September 2014 and was recorded properly. Depreciation on equipment is written off at 10% per annum on the cost price method. It's like we are going back to 1 March 2011 once more, because we are done with vehicle. Now we are facing equipment. On the information given on the question paper, I believe we will remember that there was a new equipment that was bought for 120,000. According to the question, we were told it was properly recorded. And when we look at the cost, beginning of the year it was 390,000. Now it's 450,000. No equipment was sold. Let me check quickly. Equipment. We sold. I'm sorry about that. One equipment was sold and a new one was bought. That is why there's a difference on the cost. We have to do two calculations. The first calculations will be done on the old equipment. The second one will be done on the new one. Let us start with the old equipment. The old equipment, according to the information given there, it's 390,000. 390,000, that is the cost. But because something was sold during the year for 60,000, this one. Remember, this was sold during the year. We have to subtract it from that amount and we'll be left with 330,000. We multiply that by 10% and we get 33,000. This 33,000 will keep it there and do other calculations. If you remember, there was a new equipment that was bought during the year. The cost was 120,000. We multiply that by 10% because we are using cost price method, and the answer it's no. We need to ask ourselves, for how long has this been in the business? The question paper will tell us. This was sold on the 31st of August 2014, meaning it has been used in the business from the beginning of the year until it was sold on the 31st of August 2014. Now let us do the calculation. From the 1st of March 2014, remember our financial year moves from the 1st of March 2014 to 28 February 2015. Now, from the beginning of the period, 1 March 2014 to 31 August, it's March, April, May, June, July, August. That is 6 months. 6 divided by 12. And with my calculator, that should be half of this, 6,000. The calculation above there is for the old equipment. The calculation there, it's for the new equipment. Now, because one of our equipment was sold, we need to have that calculation of the depreciation so that we can take it out, because the cost has already been subtracted from the initial cost. Now we need to do a separate calculation for the equipment which was sold. And what makes it more interesting is that this old equipment was bought on the 1st of March 2011 for 60,000, but it was sold for 60,000. It was sold on 31 August 2014 for 34,000. Sorry, that will be the cost. This is the selling price. But we are not given any total accumulated depreciation from the 1st of March 2011 to 31 August 2014. It means we have to start all over again and calculate it. On the one that is sold, the cost is 60,000. First year, let me have that old calculation so that everybody can remember. The date is the 1st of March 2011, meaning the equipment has been in the business, like that old vehicle that we calculated. That will be the first year, second year, third year, and this current year, it's its fourth year in the company. This was just to remind you so that you know why first year, second year, third year, and currently fourth year. Now, on the first year, we multiply that by 10%, and we got 6,000. That is the period 1 March 2011 to 28 Feb 2012. This period, this one. 1 March 2011 to 28 February 2012. The calculation was 6,000. Because the amount has been the same for 3 years, it will be 6,000, 6,000, 6,000. So if you add the total, it will be 18,000. In other words, whatever the value that this equipment has lost in the past 3 years, it's 18,000, which is made by 6,000 per year, because we are using cost price method. Now we are on the fourth year. That started on the 1st of March 2014 until it is sold. The question paper will remind us when was it sold. 31 August 2014. If we count from March, it's March, April, May, June, July, August. That is 6 months. 6 months, we multiplied by 10, multiply by the cost, 60,000. With my calculator, 10 divided by 100, multiply by 6 divided by 12, multiply by 60,000. 10 divided by 100, multiply by 6 divided by 12, multiply by 60,000. The answer is 3,000. Now, this old equipment, it has lost 18,000 as accumulated depreciation until the beginning of the current year. From the beginning of the current year until it was sold, this is the calculation, and the amount is 3,000. Now we go to this plus that will give us 21,000. Remember, the old equipment, we calculated 33,000 after subtracting the one that was sold. this is the current depreciation and the 6,000. This is what we need for calculation of depreciation. This is what we need for the calculation of depreciation there. We need to consider the old equipment, we need to consider the new equipment and the equipment that was sold. Now, the old equipment we said is 33,000. The new equipment, because it has only been in the business for 6 months, we calculated the amount at 6,000. And this 3,000 is the current depreciation on the one that was sold, because it was used in the business from the 1st of March 2014 until it was sold on the 31st of August 2014. Now, we take 33,000 plus 6,000 plus 3,000. That will give us the total depreciation on equipment, which is 42,000. And that 42,000 will be there. Don't forget to put it in bracket. It was a long calculation, I believe, but it's important that we understand how we arrived at 42,000. Now, we are still having the question mark there for disposals. If you remember well, one of our equipment was sold. Now, to calculate the amount, we say 60,000, which is the cost. That one. Let me do it underneath here. The cost of the equipment that was sold is 60,000. We have to subtract cost price. We have to subtract the accumulated depreciation to get the carrying value, which is the amount that is needed there. We need that amount there. Disposals at carrying value, we need it there. We have to say 60,000 minus the 21,000 that I talked about. Remember, we are talking about the equipment that was sold. The 18,000 is for the first 3 years, and this 3,000 is for the current year from the beginning of the year until it was sold. So the total accumulated depreciation written off on the equipment sold is this 21,000, which we have to subtract from the cost price and get the carrying value that we need on note number 3. With my calculator, I would say 60,000 minus total accumulated depreciation of 21,000. 60,000 minus 21,000, I get 39,000. Now, this 39,000 is the carrying value that we need there for equipment. Remember, disposals at carrying value. Now, we take 234,000 there, which is the carrying value at the beginning of the year. We add the 120, which is for the equipment that was bought during the year, and subtract the disposals at carrying value together with the depreciation. It will give us the carrying value at the end of the year, which is 273,000. Can I show it on the memo? I believe all the amounts that I have written on the question paper, you have them. if you have been following correctly. We said that minus that will give us that. This plus this minus the 39,000 that we've just calculated minus the 42,000 total depreciation for the year will give us 273,000. Now that we have this figure, it's easy to get this figure by saying 450,000 minus 273, it will give you this. Or you can say 156,000, which is total accumulated depreciation, plus 42,000, 156,000 plus 42,000 minus the depreciation of the equipment that was sold. I believe, where is my calculation? My calculation says it's 21,000, this one. If you can minus that, you will still get 177,000. Let me say it again. You take your opening balance accumulated depreciation plus the depreciation on equipment 42,000, the 3,000, 33,000 and 6,000 as it was calculated. Get the total and subtract the 21,000 of the one that is sold. You will still arrive at 177,000. I believe we spend a lot of time in this note number 3, but I believe it's worth it because most of our learners are getting it incorrectly most of the time because they do not understand what is happening. Now we are moving on. Under land and buildings, carrying value at the end is 1,500,000, this figure. Vehicle, carrying value at the end is 560,050. For equipment is 273,000. If you add up 1, 2, 3, they will add up to 2,333,050, which is a final figure for the fixed assets. According to this question, you were not supposed to show it, but you need it because if you remember well, we still have to do a question on the balance sheet, which we are going to do right away. We are done with the first part. We are moving to the second part, 4.3.2. Prepare the balance sheet on 28 Feb 2015. Look at the marks, 35. Note, this is important. Where notes are not required, show all calculations in brackets in order to earn part marks. This is important because if you don't show this, you are not going to get any part marks. Now we are moving to the balance sheet. On the balance sheet, we are going to start with the asset section. We are going to start with our asset section, 4.2.3. Under asset section, we have the first subsection, non-current assets, which I have hid a bit. Now, under non-current assets, the first thing is the fixed asset. And the fixed asset, the amount that we have just calculated from 4.3.4, this figure, that will be the first amount that you're going to start with. Fixed asset, 2,333,050. If for whatever reason you have made mistakes there and got a different figure, you take it as it is and put it in the balance sheet, you'll get a method mark. So that will be the amount that you're going to be starting with in the balance sheet. Immediately after fixed assets, we're done with that. We are going to look for information that says something about fixed asset investment or financial assets. On the question paper, Roman figure number 3, there is something on fixed deposit. The interest on fixed deposit amounts to 7,000. The fixed deposit was invested on the 1st of July 2014 at K Bank at 7% interest per annum. Remember, we are looking for financial asset amount, meaning we are looking for the amount that we have invested in the bank. According to the question, they have given us interest, which is 7,000, the date in which the money that we're looking for was invested, and the rate of interest. Under normal circumstances, we shall be given the fixed asset amount, the rate, and the time. But this time around, they have started with what we normally look for, which is the interest. In other words, let me show quickly. Normally, they would give us the fixed deposit amount, the rate, the time, and then we would look for interest. Now we are not given this. We are given the rate, which is 7%, and the time. The fixed deposit was made on the 1st of July. If you calculate from the 1st of July 2014 to 28 February 2015, July, August, September, October, November, December, January, February, that means it's 8 months. It's 8 months. And the answer, it's 7,000. Unfortunately, this time around, we need to start from there and work backwards, meaning things are not normal. When things are normal, they would give us this, and we calculate the normal way. This, we need to do it the other way, the not normal way. With the calculator, we take a 7,000, multiply, we change this 8 over 12 because things are not normal to 12 over 8. Normally 7% is written like this in accounting, but because things are not normal, we do it like this. It will give us this that we need. Let's see the calculator. 7,000 multiply by 12 divided by 8 multiply by 100 divided by 7. It gives us 150,000. Now this 150,000 is the amount that we are looking for. You will remember that this amount, which is a method mark, like I said, came from 4.2.1 that we calculated. Now this one, the 7,000 that I talked about, according to this calculation, it's 7,000. I'm there. 7,000 multiplied by 12 over 8. You are making a numerator, a denominator, and a denominator, a numerator, because things are not normal. We are working from there to there. That is why we have to swap them around. And then even the 7 over 100, that's how we got the 150,000. Now, that amount from the previous calculation and this amount from the calculation that we've just made will give us this amount for non-current assets, which is 2,483,050, which is also a method mark. Now we move on to current assets. Current assets, I believe, at this point, we know it should be inventory, which is a given amount, no problem with that. Trade and other receivables. Trade and other receivables, the instruction made it clear to say where notes are not shown, show all calculations in bracket in order to earn part marks. The difficult part on this section would be if you do not know which items are supposed to be in the trade and other receivable note. But if you know which items, then it wouldn't be much of a problem, You need to consider debtors control. You need to consider provision for bad debts. You need to consider accrued income, prepaid expense, SARS income tax. Not always. It depends on what is happening, whether you have paid more or less. Now let us look at the information given. From this information A, the following balances appeared in the general ledger of Richie Traders Limited on 28 February 2015. We are looking for items that are supposed to go to trade and other receivables. When you look at the first part, nothing is supposed to go there. When you look at the second part, we have debtors control there. It must be there. So the amount for debtors control, let me write it there. It's 151,000, 151,200. That is for debtors control. Remember what we are done with. We take it so that we don't have to go and do it again. There is provision for bad debts there, but there is no amount. It's only a percentage, 4%. Quickly with the calculator, 151,200 multiplied by 4 divided by 100, it gives 6,048. That 6,048 is an amount that must be subtracted. 6,048. Remember, this is trade and other receivables. We go back and check if there is still something. There is nothing there. Now that under information A there's nothing, we can go to additional information and check if there's anything on trade and other receivables. Page 14 has got nothing. We move on to page 15. Page 15. Oh, here's my page 15. My page 15 has got something at the top on debtors. Roman figure number 5, a debtor with a credit balance, of 11,200 must be transferred to creditor's ledger. As a debtor, you are not supposed to have a credit balance. A debtor is somebody who owes the business money. Therefore, we expect the balance to be a debit balance. But it happens for some reason that a debtor can have a credit balance, like in this case. If that is the case, the amount must be transferred from the debtor's ledger to the creditor's ledger. It means you're going to have two entries, one under trade and other receivables, another one under trade and other payables, because we are doing the balance sheet. Don't forget, 11,200 must appear in both trade and other payables and trade and other receivables, because it's a transfer from debtor's ledger to creditor's ledger. Remember, we are still doing trade and other receivables. We are going to add that 11,000. It's 11,200. And when we check again, we are still on page 15. There is nothing on debtors. We go to page 16. Still on page 16, there is nothing. Remember, those that we are done with, we just tick them to show that we are done with them. Now we can go to the answer by saying 151,200 plus 151,200 plus 6,048 plus 11,000, the transfer, the provision for bad debts, and the amount for debtors control. It will add up to 156,352. 1 mark, that is for accuracy, and that will be a method mark. We are now left with two other items under inventories. Under current assets, we are done with inventories, sorry about that. We are done with trade and other receivables. We still have to do cash and cash equivalent. Let us go to the question paper and see if we have anything on cash and cash equivalent. From page 13, there is nothing. 14, there is nothing. 15, I did not see anything. Page 15, there is nothing on that. And even on page 16, there is nothing. We are only left with that. Those that we did not do anything about, we have to consider now. Let us wait a bit about the cash and cash equivalent amount, because nothing is given, but we need to work out the balance sheet. We will work out as a balancing figure. Now we go to the second part of the balance sheet, the equity and liability section. But on Roman figure number 6, there is total capital employed. Total capital employed amounts to 3,300,000 on 28 Feb 2015. This information is very much important, and I believe most of our learners did not get this one correct because they do not know what is capital employed. Because had they known what is capital employed, I believe they could have gotten this one correct. Capital employed is the sum of shareholders' equity and non-current liabilities. Total capital employed is the answer that you get when you add shareholders' equity and non-current liabilities. Shareholders' equity is made up of two items, which are share capital and retained income. Shareholders' equity is made up of two items, share capital and retained income. Non-current liabilities is made up of mortgage loan. Now, when you add shareholders' equity, which is made up of share capital and retained income, together with non-current liabilities, which is actually mortgage loan, if you add the two, according to this, the answer that you get should be 3,300,000. Now, how will this help us? This is how this is going to assist us. When we look at the information given from the opening balances, ordinary share capital 400,000 shares, 2,400,000 on 28 February 2015. That is the amount that you are going to start with. This is the amount I am talking about. This one. Share capital is 2,400,000. It's an accuracy mark, 1 mark. But we are told that when you take, let me write it down for people, for learners to understand. Total capital employed, I am saying, is what you get after adding shareholders' equity and non-current liabilities. We are told it's 3,300,000. Shareholders' equity is made from share capital and retained income. And this one from loan. When we look at the opening balances, let me check quickly from the opening balances. On the opening balances, I'm looking for the amount of loan. The amount of loan there, it's 460. 460. And the amount of share capital, we have just calculated it to be 2,400,000. Now, when you add the 2,400,000 plus 460,000, they give you 2,860,000. Sorry about that. They give you 2,860,000. Now it's easy to calculate the amount for retained income if you know that the amount of loan is this and the amount of that is that. But let us go first to the amount of loan. Let us calculate the loan before we do this calculation. Before we do this calculation, let us move on to loan. Here is my loan. The loan was taken out on the 1st of March 2012. It is repaid in equal monthly installments over a period of 7 years. 2012, remember our financial year ends 28 Feb 2015. In other words, it ends 28 Feb every year. Now, if you count from 1 March 2012 to 28 Feb, we are talking period of 3 years. 1 March 2012 to 28 Feb 2013, that is the first year. 1 March 2013 to 28 Feb 2014, that is the second year. 1 March 2014 to 28 Feb 2015, that is the third year. Now, this amount there for loan 460, it's for the remaining 4 years, because there they say the loan was for 7 years. Already the 3 years, it's not part of this amount there that I talked about. In other words, this 460 is for the remaining 4 years. Now with the calculator, you say 460,000 divided by 4. The answer is 115,000, which is the amount for the next financial year, which will end on the 28th of February 2016. Now, that means the loan 460,000 will have to subtract this amount, because this amount is no longer a long-term liability but a short-term liability. In other words, from the loan amount you have to subtract 115, because that is an amount that is payable within 12 months. Now, this is how we do it. On the loan, 460,000, we subtract 115,000 because that is the amount payable in the next financial year. How did we get that? We said 460 divided by 4, it gave us 115. In other words, we are left with 415s to arrive at 460. But this 115, we have to take it out because it's a short-term liability. It will be part of the current liability under portion of loan or short-term loan. 345,000 will be the answer. 1 mark there, 2 marks there, and the answer is 345. This is what I'm talking about, short-term loan, the 115,000, which is a method mark. If you have put the same amount from the loan, you take it and put it there. If you have taken the same amount there and put it there, you will get a method mark. For the loan is 345,000. Now I'm going back to the old calculation. In our loan, 460, we have subtracted 115,000. And according to the calculation, we arrived at 345,000. Now, we are saying this plus this will give us that. Now that the amount of loan has correctly been calculated, we say this, which is the total, if we combine these two and subtract them from that one, we'll be able to get the amount for retained income. The amount for loan is this one. The amount for share capital is this one. We add this two and take the total and subtract it from this total. It will give us the amount for retained income. 3,300,000 minus 2,400,000 minus 345,000. It will give us 555,000, which is the amount for retained income. This is what it means. This plus that, if we add them together, they will give you that figure there, because we were told total capital employed is this amount. So this was easy to get. We had to make this calculation and then be able to get the retained income amount. This is what I am referring to. This is what I'm referring to. The share capital amount is 2,400,000, which was easy to get. We had to do that calculation there to get this figure. From there we say this figure plus that figure minus the figure that is given, which is this one, the balancing figure will be 555,000 for retained income. Now we are left with current liabilities. We have done part of it, and I believe we are running against time now. Let us quickly look at trade and other receivables. When you look at the question paper, from information number A, there is something on creditors control, 56,950. That should be part of trade and other. That should be part of trade and other payables. That 56,950. It's a given amount from the information. The transfer that I talked about from the trade and other receivables up there, that figure, you add it, and there's still something on the information that we still have to finish. When we check on page 14, let us quickly go back to page 14. Bank statement, we haven't yet done anything on the bank statement. When the bank statement was compared to the cash journals, the accountant realized that check number 189 was outstanding. On investigation, it was found that this check for 17,500 dated 19 March 2015 and our financial year ends 28 February 2015 had been issued to Masango manufacturers to pay the account. In other words, this is a post-dated check. Therefore, because it will be cashed in the next financial year, that will begin on the 1st of March 2015, it therefore says we have to take it back to reverse the process, because at the time it was given to Masango manufacturers, it was recorded in our books, and therefore decreased our bank balance with the amount 17,500. So it affects bank and creditors. In other words, we have to go back to creditors, add the debt with 17,500, and go back to the bank and add the bank with 17,500. Let's go back to the memo quickly. The 17,500 that I'm referring to, on the trade and other payables, we add it because the actual payment was never made. the actual payment was never made, so we have to reverse the process. That is why we are adding it to trade and other payables. Unfortunately, we owe the bank. We don't have anything under cash and cash equivalent. Therefore, we are standing at 470,000 as bank overdraft. Therefore, we have to decrease that bank overdraft by the same amount, 17,500, because the payment was not actually made. And then that will be accuracy mark, and then method mark. We still have information under, we are done with that one. On page 15. Page 15 quickly. We're done on page 15, you go to page 16. We are left with only one item on page 16. Rent income. Rent income amounted to 53,120 for the year. It included the rent for March 2015, and if you remember well, our financial year ends 28 February 2015. The rent increased by 14% on the 1st of February 2015. Let us get this correctly. Rent has been received for 13 months, but on the 1st of February, it was increased by 14%. That means February is the last month of our financial year. In other words, for the first 11 months, no problem. The only problem that we had was the increment at the beginning of February for 14%. In other words, like it has included the rent for March, February and March include the 14% increment. So we have to make that calculation. The calculation quickly. The first 11 months, there was no problem. So the amount remained constant. There we multiply by 100. But for the other 2 months, February and March, there was a problem with the increment 14%. We have to add the 14 to the 100, which makes 140. 11 by 100 is 1,100. 2 by 114 is 228. Total month received is 13. 1,100 plus 228 will give us 1,328. Now we take this calculation, 228 divided by 1328, multiply by the total amount received, 53,120. It gave us 9,120. But now this 9,120 is for 2 months. That include the increment of 14%. We have to divide that by 2 to get the amount for 1 month, because according to this, only 1 month has been received in advance. The 4,560 is our income received in advance, which is part of trade and other payables on the balance sheet. This is what I'm referring to. Trade and other payables there. The amount that I've just calculated, 4,560 for 3 marks. If it's correct, 3 marks. If it's not correct, 1 method mark. It's 4,560. Let me check if we still have another information that we still have to do. Yes. On page 14 once more, I believe this is the last one. Additional information, Roman figure number 1, dividends. A final dividend of 20 cents per share was declared by the directors on 28 Feb 2050. A final dividend of 20 cents per share was declared on 28 February. Now we need to multiply this 20 cents by number of shares, but we need to go and under shares what was happening. We have to multiply the 20 cents by the number of shares, which is there on number 1, ordinary share capital, with the calculator 20 divided by 100 multiply by 400,000 shares, which will give us the 80,000. 80,000 is what is owed to the shareholders. 80,000, this figure there for 2 marks, is what is owed by the shareholders, 80,000. From there, you add up everything on trade and other payables, you'll arrive at 176,172. You add the short-term loan, which was calculated above, together with the final answer for bank overdraft, that figure there. If you have added correctly, you will get 743,672. Now, the total shareholders' equity, 2,955,000, which is made by the 2 items, share capital and retained income, plus the mortgage loan of 345, plus the amount that we've just calculated, will add up to 4,043,672, which will be the total equity and liability, the total amount for the section equity and liability. And this amount, if you remember well, when we can go back to the first part, we had the fixed asset, the financial asset, and that gave us the non-current asset amount, that figure there. Current asset, we had inventory which was given. This was calculated. We never had anything on cash and cash equivalent. But now that we have the figure for equity and liability, the figure there, it's easy to say this. If you work it out, it will give us 6,270 as the balancing figure. Now the 2 sections will have the same amount, 4,043,672. We shall be taking a short break. We'll be coming just after a few minutes. Welcome back after break. We are continuing with question 5. That is the cash flow statement, analysis and interpretation of financial statements, for 80 marks, 35 minutes. The information below was extracted from the books of Nandi Pue Ltd. Study the information and answer the questions that follow. Required, match column A with explanations in column B on the answer book. 5.1.1 up to 5.1.5. In the interest of time, I will go straight to the answers. Companies and Intellectual Property Commission, that should match the explanation in B, responsible for maintaining records and control of new and existing companies. The first one, the answer is number B. The second one, it's E. The third one, A. The fourth one, C. And the last one, D, for $5. Moving on to 5.2. Prepare the reconciliation between the net profit before tax and the cash generated from operations. Show workings in brackets. Show workings in brackets. According to the information given on the answer book, we have, there's a space there, is nothing, but we need to start with net profit before tax. After that, we'll continue with others, but net profit before tax is not given. Now we need to look for information that will assist us to be able to calculate the net profit before tax. When we look on the question paper, page 20 of the question paper, Roman figure number 4, this one, it says income tax for the year amounted to 287,500. This part that is handwritten did not appear on the question paper, but we got the information that we should write that because it was an omission. This is 30% of the net profit. Now, if we are given the amount for income tax as 187,500, and that is 30% of the net profit, that information will help us calculate what we are looking for, which is the net profit before tax. How do we do that? We take 187,500, multiply by 100 over 30 to arrive at 625,000 for 2 marks. Moving on to adjustment for depreciation and interest on loan, the two amounts were given. Now we need to go to changes in working capital, starting with inventory. According to the question paper, when you look at the information given, inventory 2014 it was 1,150,000, 2015 1,145,000, and if you work that out from 1,150,000 to 145, there's a decrease of 5,000. I believe that was easy to calculate for 2 marks. Decrease in inventory for 5,000, 2 marks. It's an inflow of 5,000. Now we move to debtors, trade and other receivables. On the question paper, when you look at the information given on the question paper, we have 1,139,000 for 2014, 1,143,000 for 2015, but there's a note for that. If you can quickly check the note for trade and other receivable. Debtors control for 2014 is 1,130,000. For 2015 is 1,115,000. There is prepaid expense for both years, but there is SARS income tax. And according to the principle of accounting, tax must be shown separately in the cash flow statement. Therefore, this amount there includes the 18,000. Therefore, we cannot use that amount. Instead, we have to use this amount, that amount, this amount, and that amount. This on the column 2014, no problem, because there is no SARS income tax. We will use that amount, 1,139,000. Here, we cannot use this amount. Instead, we'll add this amount and that amount. They add up to 1,125,000. Now, with the calculator, we say 1,139,000 from 2014 minus 1,125,000. It gives us 14,000. Now that 14,000 is an increase. Let me see. No, 1,139,000. If you subtract 1,125,000 from that. It's an let me see correctly. Let me do it again. Sorry about that. 1,139,000. If you work it with 1,125,000, 1,125,000, you get 14,000. That 14,000 carries 2 marks because you had to do away with the 18,000 that was given as a note. On the note, that 18,000 is not supposed to be included in the calculation of trade and other receivables because, like I said, this 18,000 must be shown separately with text on the face of the cash flow. So the correct amount is 14,000 there for 2 marks. And that was trade and other receivables. We go to the next one, trade and other payables. Trade and other payables. 929,000, that must be compared with 1,185,000, and I believe there's also a note for that. On the note, creditors control for both years. There is SARS there and there's shareholders for dividends. SARS, like I said, it must be shown separately. Shareholders for dividends, dividends also must be shown separately in the cash flow statement. Therefore, we need to consider only the two amounts, 850,400 together with 955,000. With the calculator, 850,000. If you work it out, you will get 104,600 for 2 marks. And if you add them correctly, you will get 123,600. From there, you add from 625 plus 18,500 plus that, 125,000, you will get 768,500. If you add that to, if you add 123,600 to the 768,500, you'll get 892,100, which is the amount to be taken to the cash flow statement. We are done with preparation of the note reconciliation between net profit before tax and cash generated from operations for 10 marks. Now 5.3, calculate the figure for income tax which appears on the cash flow statement on 30 June 2050. Calculate the amount that should appear on the cash flow for number 1. We go to the information that is given to us so that we are able to calculate correctly. We go back to income tax, Roman figure number 4. The income tax for the year is 187,500. We need that figure. Now, after having that figure, we need to go to the note, trade and other receivable and trade and other payable to check where the opening and closing balances of the income tax are. On page 19, trade and other receivable, there is something on SARS income tax 18,000, and that is the closing balance. On trade and other payables, there is something on SARS income tax 5,000, that figure there, which is the opening balance. Now, this is how we should do it. Under normal circumstances, we expect SARS to be owed by us, not the other way around, SARS owing us. We are expected to be giving SARS money, not SARS giving us money. But when things are normal, you will have the opening balance and the closing balance under trade and other payables to show that we owed SARS and we are still owing. But it happens that at times we pay more than we actually should have, and that's how SARS ends up owing us money, like it is the case with this question. This 18,000, we have paid more, that is why now SARS is owing us 8,000. And the calculation would be, we start with the opening balance 5,000. We take the 5,000 and add the income tax amount of 187,500, this figure. We take this one, add it to the 5,000 of the opening balance. Normally, we would subtract if the closing balance is under trade and other payables. But because it is there, now we have to add. Let me say it again. Under normal circumstances, we expect SARS to be owed by us, not SARS owing us. But for some reasons, it happens that we pay more than we should actually pay. If that is the case, the calculation would be opening balance, because it's correctly placed, this one. This is how it should be. We should be owing SARS. We take the 5,000 and add it to the 187,500, which is the amount of tax for this year, and add the amount that SARS is owing us. Under normal circumstance, it would be subtracted if it's here. But because it is not there, it's there, we add up everything, 187 plus 5,000 plus 18,000, which will give us 210,500. Let me confirm it quickly. I set the opening balance plus the income tax amount for the year plus that 18,000, because things are not normal. We are supposed to be owing SARS, but SARS is owing us, so we add, and then it's 210,500 outflow of funds. You can do it the other way around to say, because this should be a negative figure. Instead of adding, you can instead of subtracting, can add negative figures. They will still end at 210,500 negative. We move to the next question. The next question says 5.3.2, calculate figures for dividends which appeared on the cash flow statement. Remember, on the cash flow statement, we are talking the money paid only. For 4 marks, calculate dividends which will appear in the cash flow statement. We go to additional information. On additional information about shares, on the 1st of July 2014, 120,000 shares issued at 10 rands each. Bullet 2 says on the 1st of January 2015, 80,000 new shares were issued at 15 rand. These shares did not qualify for interim dividends. On 30 June 2014, repurchase 20,000 shares at 14 rand each. Now, the 120,000 shares, where is the other information? We are going to look at trade and other payables under shareholders for dividends. The opening balance is 74,000. The closing balance is 230,000. Now, during the year, that is on the 1st of January 2014, 120,000 shares were issued, and those did not qualify for interim dividends. The amount that should be paid, or that will appear in the cash flow statement as dividends, we are going to take this 74,000, which is the opening balance, and take 120,000 multiply by 80 cents. 120,000 shares multiplied by 80 cents will give us 96,000. Now the amount that has been paid is for 120,000 because the 80,000 did not qualify for interim dividends. We are going to take this 120,000 and multiply by 80 cents and get a figure which is 96,000. From that figure, we add the 74,000 because this amount is the amount that the business owed to the shareholders for their dividends beginning of the year. So the amount paid for dividends, it's this 74,000 plus the amount paid for 120,000 shares during the year. So 74,000 plus 96,000 will give us 170,000, which is the figure that will appear. That will be the figure that will appear in the cash flow statement as dividends. The 74,000 plus the 96,000, which is a calculation made from 120,000 multiplied by 80 cents, it will give us 170, which is the actual amount paid for dividends as they would appear in the cash flow statement. We move on to the next question. Complete the cash flow from investing activities section of the cash flow statement on 30 June 2015 for 9 marks. Cash flow from investing activities. This one is the calculation. For you to be able to get this one correct, you should know which information goes to the investing activities of the cash flow. Here we're talking fixed assets, we're talking financial asset, fixed asset and financial asset. Let us start with fixed assets. We are given the closing balance and the opening balance, but we still have to go and check on the information if we still have any other information that we need. One of the things that makes this calculation easy is if you note number 3 of the balance sheet, the fixed asset note. The first part, the opening balance. Let me write it down quickly. The carrying value at the beginning, plus what is happening at the end of during the year. That could be additions at cost, disposals at carrying value, depreciation, and then carrying value at the end of the year. This calculation or this information will make the calculation very easy. When we look at the information given, fixed asset closing balance, it's 1,039,500. The opening balance 774,800. 774,800. We need to check from the question paper if we have anything like depreciation. The amount is given there is 18,500. Put it there, 18,500. We need to ask ourselves if we have sold anything. We need to go and check. Yes, we have sold something. There is sale of equipment. Details of equipment sold at carrying value. Cost is 60,000. Accumulated depreciation to the date it was sold, 40,570. 60,000 minus 40,570 will give you this figure, 19,430. So that is your disposals at carrying value. 14,000 that. Now that we have this information, this is what we are looking for. Fixed asset purchased. How much we spend on fixed asset. Now we need to start working bottom upwards. We take this figure, 1,039,500. Because depreciation is normally subtracted, but we are moving from down upwards. Whatever that we subtracted will be added. That plus 18,500 plus 19,430 minus the opening balance 774,800, and the answer would be 302,630. I believe this calculation makes it easy to understand. If only you understand note number 3, it becomes easy because you start from carrying value at the beginning and you work up to carrying value at the end, and then you take it from bottom upwards. Whatever that was subtracted as you're going down, when you go up, you will add, you will subtract, and then you will get this figure, which is 302,630. Let me confirm that on the memo. On the memo, they have done it differently because they took land and buildings. Okay, let me quickly do it according to the way they have done it on the memo. Let us start with land and buildings. It was 700,000 2014. In 2015, it's 950. The difference thereof, there's an increase of 250,000, meaning we bought something as land and buildings for 250,000. And the 250,000 that I'm referring to is that one. From there, we took the 74,800, 89,500, because that is the book value. The opening balance of 89,500 we added, that one. The closing balance we added and subtract the closing balance. Here is the amount that I'm referring to, which was subtracted. And the other two amounts are for depreciation, 18,500, and the disposals at carrying value, 19,430. The only difference is that they have separated this amount 250,000 from this 89,500. But all in the same way, it will give us 302,630. Proceeds from sale of asset, that is the amount that was calculated there. It's an inflow. That amount must be an outflow. And on the fixed deposit, it matures and the correct amount is 50,000. And if you look at it, the bigger amount is in brackets, therefore the final answer is in brackets. I'm sorry about this, but in the interest of time, I need to end here. I wish all the grade 12s best of luck in their forthcoming August test, September examination, and final examination. Thank you.